Okay, so you want to own a roofing company. No storefront to build out, no $1 million building to construct, no health department to satisfy, just a truck, a ladder, a crew, and a phone number. People call the day their ceiling starts leaking. Low overhead, high demand, and every single house in America eventually needs you whether they like it or not. That's the pitch. That's why roofing shows up on every list of recession-proof businesses you can start for under 50 grand. Here's the problem. Roofing looks like the easiest business to start in America, and that's exactly why it's also one of the easiest ways to go broke fast. Because a roofing company isn't really a construction business. It's an insurance-adjacent, weather-dependent, cash flow timing business that happens to install shingles. And once you understand that difference, everything about how a roofing company actually makes money, and how it quietly runs out of cash while looking busier than ever, starts to make sense. Let's start with what it actually costs to open the doors, because the barrier to entry here is genuinely low, and that's part of the trap. You don't need a building. You don't need a lease. You can run a roofing company out of a home office and a pickup truck. Basic startup costs. Yaz, a used truck or two, a trailer, ladders, nail guns, air compressors, safety harnesses, basic hand tools, and a website can realistically run somewhere between $10,000 and $50,000, depending on how much equipment you buy new versus used. That's the number that gets repeated in every start a roofing business video on the internet, and it's technically true. It's also almost meaningless because it describes the cost of buying tools, not the cost of running a business. The real first gate isn't equipment. It's licensing and insurance, and this is where a lot of would-be owners get their first shock. Most states require a contractor's license specific to roofing, which usually means passing an exam and proving a certain number of years of documented experience before you're even allowed to legally pull a permit. Then comes insurance, and roofing insurance is not like insurance for a coffee shop. General liability coverage for a roofing company, given that you're sending crews onto steep, high, unstable surfaces above other people's homes, typically runs $3,000 to $10,000 a year for a small operation, and workers' compensation insurance, which is legally mandatory the moment you have employees, is priced specifically against roofing's injury statistics. Roofing carries one of the highest workers' comp rates of any trade in construction, because falls from roofs are consistently among the leading causes of construction fatalities in the country. Depending on your state and your claims history, workers' comp for roofing crews can run anywhere from $15 to $35 per $100 of payroll. Compare that to an office job, where the same coverage might run under $1. If you're paying a crew of 4 roofers $50,000 each in a year, that's $200,000 of payroll, and workers' comp alone at a mid-range rate could cost you $30,000 to $50,000 before a single shingle gets nailed down. That's not a rounding error. That's a second employee's salary, spent entirely on the privilege of being allowed to send people onto roofs legally. Now, the trucks and equipment. A used pickup with a ladder rack and towing capacity for a trailer runs $15,000 to $40,000. A dump trailer for hauling old shingles and debris to the landfill adds another $5,000 to $15,000. Nail guns, compressors, harnesses, and safety gear for a crew run a few thousand more. None of this is dramatic on its own. What is dramatic is what happens when you try to scale. One crew with one truck can only physically complete so many roofs in a week, realistically 2 to 4 residential roofs depending on size and crew skill. If you want to grow revenue, you don't get to just work harder. You have to add an entire second truck, a second trailer, a second full set of tools, and a second crew, which means doubling almost your entire fixed cost structure just to double your capacity. Roofing doesn't scale the way a software business scales. It scales the way a fleet of small factories scales. Linearly, expensively, one crew at a time. Here's the cost that catches almost every new roofing owner off guard. And it's not tools or trucks. It's marketing and lead generation. Because here's the uncomfortable truth about roofing demand. Almost nobody wakes up excited to buy a new roof. People buy roofs because something broke, because a storm damaged their house, or because a home inspector flagged it during a sale. That means roofing is what's called a distress purchase industry, and distress purchases require you to be visible at the exact moment someone needs you, which is expensive. Roofing leads through paid advertising platforms can cost anywhere from $50 to $300 per lead depending on your market and how competitive it is. and a meaningful share of those leads don't convert into an actual signed job. Industry close rates on roofing leads typically run somewhere between 10 and 40%, depending on how good your sales process is. Do the math on that. If you're paying $150 a lead and closing 1 in 5, your customer acquisition cost alone is $750 before you've bought a single shingle for that job. On a $12,000 roof replacement, that's over 6% of the entire job's revenue spent just getting the customer to say yes. So how does a roofing company actually make money once a job is signed? This is where the business gets genuinely interesting, because roofing has two almost entirely separate revenue streams that behave completely differently, and confusing them is one of the fastest ways to destroy a roofing business. The first stream is retail work. Homeowners who call because they want a new roof, they're selling their house, or their existing roof is simply old and failing. On retail jobs, you control the entire pricing conversation. A typical asphalt shingle roof replacement on a mid-size home runs somewhere between $8,000 and $20,000 depending on the region, the roof's size and pitch, and the materials chosen. Materials, shingles, underlayment, flashing, vents, nails typically run 30 to 40% of the total job cost. Labor runs another 30 to 40%. That leaves a gross margin before overhead somewhere around 30 to 40% on a well-run retail job. On retail work, you're the one setting the price, which means a well-run sales process, good reviews, and strong branding can meaningfully improve your margins over time. The second stream is insurance restoration work. Roofs damaged by hail, wind, or storms, where the homeowner's insurance company is paying for some or all of the replacement. This is where roofing gets structurally different from almost every other home service business, and it's worth slowing down on, because it explains both the biggest opportunities and the biggest legal landmines in this industry. When a storm rolls through a region, insurance claims for roof damage spike immediately afterward, and roofing companies that specialize in storm restoration essentially become insurance claims processing businesses that happen to also fix roofs. Here's how the money actually flows. The homeowner files a claim. An insurance adjuster inspects the roof and determines the scope of covered damage and a price based on standardized estimating software the entire insurance industry uses. The insurance company pays out based on that estimate, minus the homeowner's deductible. The roofing company's job, especially in storm restoration, is as much about correctly documenting damage and negotiating the scope of the claim with the adjuster as it is about the physical labor of installing the roof. A roofing company that's skilled at this, knowing exactly what building codes require to be included in a claim, knowing how to document damage the adjuster might miss, knowing which supplements to legitimately request when the actual cost of doing the work correctly exceeds the initial estimate, can meaningfully increase what gets approved and paid without doing a single extra hour of physical labor. This is also where roofing has developed a genuinely bad reputation in some markets, and it's worth being honest about why. Storm chasing companies, crews that follow major hailstorms across state lines, going door to door offering free roof inspections, and in some documented cases offering to waive the homeowner's deductible, which is against most state insurance regulations and against most insurance policy terms, became such a widespread problem after major hail events that a significant number of states have passed specific legislation regulating this exact behavior. Waiving a deductible is effectively insurance fraud in most jurisdictions because it changes the actual cost basis the insurance claim was calculated on. Legitimate storm restoration companies build lasting local businesses on trust and workmanship. Storm chasers extract value from a region for one season and leave, sometimes leaving homeowners with warranty claims nobody's around to honor. If you're building a real roofing company, insurance work is one of the most profitable revenue streams available to you. But only if you play it completely straight, because the regulatory and legal exposure for cutting corners here is severe, and it's exactly the kind of headline-making mistake that can end a company overnight. Now let's talk about the number that actually determines whether a roofing company survives its first 3 years, because it's not revenue, it's cash flow timing, and this is the single most misunderstood part of this entire business. Picture a $15,000 insurance restoration job. The homeowner signs the contract. Your crew needs to buy materials up front. Call it $5,000 to $6,000 before a single shingle goes on the roof. Your crew works for 2 to 3 days. You pay their wages immediately because roofers, understandably, don't wait a month to get paid for climbing onto a roof. So by the time the job is physically finished, you might have $9,000 to $10,000 of your own cash already spent. Now here's the part that surprises new owners. Insurance claims don't pay out all at once. Most insurance companies pay in 2 installments. An initial payment when the claim is approved, called the actual cash value payment, and a second payment, called the recoverable depreciation, that only gets released after the homeowner submits proof the work was actually completed. That second payment can take anywhere from a few days to several weeks after job completion to arrive, depending on the insurance company's internal processing speed and how promptly the paperwork gets submitted. On a large storm restoration job, that second check can represent 20 to 40% of the total contract value. Multiply that lag across 10, 20, 30 jobs running simultaneously during a busy storm season, and you can have a roofing company that is, on paper, wildly profitable and successful, while its actual bank account is dangerously thin because hundreds of thousands of dollars of already earned revenue is sitting in insurance company processing queues instead of the business's checking account. This is precisely how profitable, busy roofing companies run out of cash and collapse. Not because the work wasn't there, not because the margins were bad, because the timing between paying your crew and collecting your money created a gap that ate through working capital faster than the owner expected. This is exactly why experienced roofing owners obsess over something called work-in-progress management, and why the smartest ones keep a cash reserve specifically sized to cover the gap between labor payouts and insurance collections, not just general operating expenses. A roofing company can be genuinely, sustainably profitable on paper and still fail because of a solvable, boring, unglamorous cash timing problem that nobody warns first-time owners about clearly enough. Seasonality compounds all of this. Roofing is not a business that generates steady, predictable monthly revenue. In colder climates, roofing work slows dramatically or stops almost entirely for several months of winter. You generally can't properly install asphalt shingles below certain temperature thresholds because the adhesive strips on the shingles need warmth to seal. That means a roofing company in the northern half of the country might generate 70 to 80% of its annual revenue in a 7 or 8 month window while still carrying fixed costs, insurance, truck payments, a small core administrative staff, through the slow months. Owners who spend their peak season cash as if it were a steady, permanent income level are the ones who get caught short every single winter. The ones who survive treat the busy season the way a farmer treats harvest. Build the reserve now, because the lean months are guaranteed to come. There's also a labor problem sitting underneath the entire industry that's gotten worse, not better, over the past decade. Roofing is physically brutal work. Extreme heat, extreme heights, heavy lifting, and it's genuinely one of the more dangerous trades in America by injury and fatality statistics. That combination makes it a hard trade to staff. Experienced roofing crews are in constant demand, which pushes wages up and makes retention a real strategic problem, not just an HR footnote. Many roofing companies, particularly in regions with the tightest labor markets, rely heavily on subcontracted crews rather than direct employees, which changes the entire cost and liability structure of the business, shifting workers' comp exposure but also shifting quality controls and scheduling reliability onto crews. The company doesn't directly manage day-to-day. Get that subcontractor relationship wrong, an unlicensed or underinsured sub gets hurt on a roof you booked the job for. And the legal and financial exposure can land back on your company regardless of the subcontracting arrangement on paper. Let's talk about equipment breakdowns and vehicle costs too, because they're not dramatic individually, but they compound the same way they do in every field service business. Trucks used daily for hauling heavy loads of shingles and debris depreciate and break down faster than a typical commercial vehicle. Ladders, nail guns, and compressors need regular maintenance and periodic replacement. Dump fees for old roofing debris at the landfill add up, often running $200 to $500 per job, depending on the roof size and local disposal rates. And that's a cost that's easy to underestimate when you're pricing a job on a napkin instead of a proper cost sheet. So let's put all of this together and look at what a real roofing company's year can actually look like, because this is where the two very different versions of this business reveal themselves. In the optimistic scenario, you've built a strong local reputation. You have a mix of steady retail work and well-managed insurance restoration jobs. Your crews are skilled and retained, and you've built a cash reserve that survives the winter slowdown without panic. A single crew, running efficiently, can complete somewhere around 100 to 150 roofing jobs a year, at an average job value of $10,000 to $15,000. which puts annual revenue for a well-run single-crew operation somewhere between $1 and $2 million. After materials, labor, insurance, marketing, and overhead, a healthy roofing company can run a net profit margin of 10 to 20%, which on the high end of that revenue range can mean an owner take home of $150,000 to $300,000 a year. Add a second and third crew once the systems and cash reserves are solid, and that number scales, though never as smoothly or as cheaply as it looks on a spreadsheet, because every additional crew reintroduces the same fixed cost jump you dealt with the first time. In the realistic scenario, 2 or 3 unglamorous things go wrong in the same year, and none of them are exotic. A slower storm season than the previous year means fewer high-margin insurance restoration jobs and more competition for the retail work that's left. Lead costs climb because every roofing company in the region is bidding on the same online advertising keywords after a competitor moves into your market. An insurance company slows down its claims processing after a major regional storm overwhelms their adjusters, stretching your cash collection gap from a few weeks to 2 months on a chunk of your outstanding jobs. Under those conditions, that same $1 to $2 million revenue business can slide from a comfortable double-digit margin into a single-digit margin, or into a genuine cash crunch that forces the owner to draw on a line of credit just to make payroll during a month where 3 big insurance checks are still sitting in processing. None of this shows up as one dramatic failure. It's a slightly slower month, a slightly longer claims processing wait, a slightly more expensive lead, compounding quietly until the bank balance looks nothing like the profit and loss statement suggested it should. So if you do decide to start a roofing company, remember the thing that actually determines whether you make it past year 3. It was never really about how many roofs you could put up. It's about whether you can survive the gap between doing the work and actually getting paid for it. Because in this business, being busy and being profitable are 2 completely different things, and only one of them keeps the lights on in February.